Ooh, this is a fun one. Let's dive into looking at consolidation and momentum in the market. It's very easy to say and to look at. It's much harder when you're in the live, trading environment to always be able to identify when you're 100% in a range versus just when price is bouncing around for just a moment or is just in a small pullback. And so when we look at consolidation and momentum, we see two examples right here on this slide. Both selections that I have made are 36 bars. And we could say right now that a bar is going to be the equivalent of hour each one. I think it was actually the 15-minute chart that I was on, but we're just going to say that it was an hour. So we're going to say that these 36 bars are both in these squared off areas. So both of these squared off areas here contain 36 bars, and I've included a little bit of information on each side so that we can kind of get the full concept and have something to compare to. This is called a consolidating market or a ranging market, and that happens when the market is just moving sideways. It doesn't really have a direction. It's just ranging back and forth, and it's not even hitting each side. And that trying to trade a ranging market is a good way to blow your account. It is a good way to give up all the profits that you have already bagged for yourself that week. And so the biggest lesson that I want you to take away from this is that we do not trade ranging markets. We do our best to stay out of ranging markets, and we try to wait until price breaks out and decides to move on in whichever direction it's going to outside of that ranging market. In this example, in this consolidation and ranging market, this was a 19 pip range that for 36 hours, price sat in and basically just ranged back and forth. And we have over here on the right-hand side, the same 36 bars, which we said were 36 hours of an example of momentum in the market where liquidity was found, and we see an impulse movement. And so what we see is the same 36 bars had price push up and pull back, and all of these candles you'll look at are larger. I have them kind of shrunk down just so that they would all fit in this graphic, but all of these candles are larger, and you'll see this movement, this equivalent movement in time moved 211 pips versus this 19 pip ranging. And so anytime there's momentum and liquidity that's found in the market, price is going to push, and we call that an impulse move, or pushing up, or price flying, or price plummeting, just depending on which direction that you're going. And this is what you want to trade in. You want to find the areas where there is momentum picked up in the market, not where the market is stalled out and just going sideways without a true direction. You're never going to know 100% which direction the market is going, when it's turning, exactly what turn point. Every now and then you're going to be able to make, educated predictions through your type of strategy analysis or through your edge in the market, and that's great. But anybody that comes in and says that they can, consistently pick tops and bottoms in the market and consistently know exactly what the market is going to do there, that's just not the way it works. You don't ever know. You can create strategies that give you an edge, but just because you have an edge or have something that happens consistently or has the probability once a certain setup sets up in the market to to have a certain reaction, it doesn't mean that tops and bottoms are always picked. But again, what you're wanting to do is stay out of ranging markets that really don't go anywhere. And oftentimes these ranging markets, again, will just kind of take out your stop losses. We'll have liquidity grabs, we'll have all kind of different pitfalls for you. Whereas if you look and try to trade the areas that are an impulse move, you'll be able to grab entries and you'll be able to grab pips and add positions all the way through until price, either goes against you or till it starts ranging. I mean, you've got a small range right here. You've still got some momentum right here, but you see candlesticks are getting a lot smaller here. And so this is showing you that the market is running out of steam, where here, even going up here, you had larger candlesticks. And again, just remember, like, this is a little bit of a shrink graphic versus here because it was so much bigger. Let's flip over to that live chart and identify a couple of other examples of consolidation and momentum areas in the market. Check out this really clear example of the areas of consolidation, or where the market is ranging and moving sideways, versus where you have an impulse move in one direction or another. I pulled those examples off the Euro Yen, which is a pair that I've been trading lately. And if you see right here, this is where I pulled the ranging area from, and you see how small the candles are. You see that they're really just kind of going sideways. They're not really having very much movement to them, versus where I picked this is the same zoom, no manipulation whatsoever, versus the same time frame, the same, number of bars that are squared in, except that this is where the market has picked up liquidity here and had an impulse move and just flew. Price just took off. And you see that the candles are much larger, that the movement is more pronounced. And so that is where, when you hear somebody refer to the market having momentum, where it is moving really well in a certain, direction, it can still have pullbacks and still continue to move really well. I'm going to flip over here to the 1 hour chart, and let's just kind of go through and just identify areas of momentum versus when the market is ranging. And again, everybody is a genius in hindsight. Everybody is a genius when they're looking at the charts like this. It's much harder and takes time to really craft the skill of identifying when you're in a range while you're on the live charts trading. But just looking right here, I would say we obviously can see, just by glancing at the chart, that we're looking at a trending market. That's fabulous. We can identify that. But if we just kind of break down what happened only on one time frame, just the hourly time frame right here, in times of, when did you have times of ranging, when did you have times of more momentum? Obviously, you see, right here, we've got an area of momentum, but right behind that area of momentum, you see the market paused and just moved sideways. And how long did it move sideways for? It was for 15 hours. So for 15 hours, the market just sat in I didn't even look to see how many pips that was, in about a 25 to 30 pip range. The market just really didn't move. And right before that, if you even take this, it moved up about 385 pips, and then all of a sudden it just stopped. And so that was ranging, that was momentum. And you see, other times where the market just kind of stalls out. You see kind of a base right here where market kind of stalled out. You see pushes where you have big momentum candles, where the candles are bigger than the ones around them right here. It's a big, couple of institutional candles there, and where there obviously is an order block here I would actually put the order block probably right here where price leaves, dips back in, grabs more from that price range, and then moves on out. You have where price kind of ranged a little bit right here. It wasn't fully sideways, you know, moved on up, but then you have a complete sideways movement with a little bit of people's stop loss taken out, a little bit of liquidity engineering going on right there. You also have a little bit of a liquidity grab right here where you have people's stop losses that were put in, you know, above these highs, and you have stop losses that were put in right here below these two lows. Price goes down, grabs the liquidity, comes up, fakes everybody out, goes sideways, grabs liquidity again, comes down, hits the bottom of the range, and then goes ahead before moving on out of that sideways movement. But for me, the sideways parts, that is called consolidation. That is called ranging market. You want to try to stay out of those areas. Again, easier said than done, but the more practice you can put in trying to identify when you're in a ranging market, when versus when the market had momentum, the better off you'll be. If you notice one thing about this range right here, again, is how, you know, small these candles are right here versus when you have momentum in the market. Like, look how much bigger. It doesn't mean there's not small candles and times of indecision, but it just does mean overall that there is a lot of momentum in the market. You've got momentum, you know, to move you up here. If we just kind of come down on a bigger view, you would say this whole area right here is a range. All of that is a ranging market. I wouldn't look for trading of this. Most of this right here, even though price is bouncing around a little bit, I would look to that as a possible reversal and kind of wait for a breakout before trading that. Again, even though you have, you know, some profit being taken and some liquidity, you know, being grabbed because everybody's stop losses are basically sitting right here, right above these highs for the people whose bias is, you know, that price is going to bounce around for a minute and then, you know, drop lower. It takes out that stop loss and then, you know, moves on. You have a ranging, you know, range within a range right here where price is just going sideways, not one direction or another. Then you had price push up, grab liquidity, or have everybody commit to, you know, prices right now taking off, you know, coming, it's going to shoot up. So everybody's committed. And then what does price do? You know, it comes back down, takes out everybody's stop losses before finally, you know, moving up. You've got to be able to tell the story of what happened in the market. And again, this isn't necessarily the video on teaching liquidity and liquidity engineering and, you know, manipulation of the markets. It is more though understanding and getting into the habit of identifying possibly where you shouldn't be trading. Just stay out. Again, you're never going to get every high and low. Some of them you're going to miss, but when you start seeing, you know, price break out of this area, this range, you know, you kind of had two little ranges in here. When you start seeing price move out of that, that's when you start going, oh, okay, so there's some momentum. So yes, price did hit, you know, down here, and times you're going to grab that. That would have been a valid entry for me with my strategy, but a safer and more conservative approach. And sometimes the approach I take when I'm not real sure, you know, is absolutely waiting for price to leave a range when it's in a ranging market like this, for price to leave, come back and retest that range. And so you would instead, the safer thing would be to try to grab, you know, pips from above the range, you know, so you would try to grab pips from this area once it leaves the range and then comes back and retests to confirm that it's moving out. But again, does it move out? Well, we see price comes right back into that same range again and bounces around. And so again, that's not the best trading time. You know, you don't know for sure if that price is going to, you know, push up, because price could just as easily bounce around in this range and then come and move down, come back and retest the range, and then, plummet. It can do that. You're never ever going to know, but what you do know is that you want to protect your capital and you want to hold on to your money. And so you want to learn to identify when the market is ranging and when it has momentum. You can't always tell. There can be large candles within a range. There can be small candles within momentum. But as a whole, a impulse move, or when there's high liquidity being taken, when there's momentum in the market, that market is moving. You are going to have pullbacks. It's not going to be perfect every time. And so that's why you craft a strategy around a trading edge that lets you get in and out of the market. But if you're smart, you'll get one that has you stay out of ranges and that doesn't look for entries until price has broken structure and possibly even come back to take liquidity and then pushed on through. So momentum is your friend. You'll hear people say all the time, the trend is your friend. Going with trend, but I even go further and go momentum is, what I'm looking for. And I'm looking for entering after, people have been faked out, after, inducement or liquidity engineering has taken place, after some manipulation has happened, when there's some imbalance in the market, some of those times are ripe for picking. And we'll go over some of those concepts and you'll see them in other strategies of how I kind of pull this knowledge into a trading edge in the market. Again, this is just go through. When do we have momentum? When do we have stagnation? When is the market just sitting and not really going in a direction? And when do you have movement where price is traveling from one price to another price, either bullish or bearish? So enjoy starting to play with the market. I cannot stress how easy this seems and how much in your mind you would say, I don't need to practice this, and how much you actually do need to practice this. This will be core in, again, saving and protecting a lot of your capital. So have fun working with it, and just know that throughout your career, you want to keep honing and sharpening your skills with this particular, part of market anatomy or market movement.